Hello, everyone, and welcome to another year of our Health Reform Beyond the Basics webinar series. This is Hallie Cloud, and thank you for joining us today. For those of you who are new to our webinar series, this is a project of the Center on Budget and Policy Priorities, which is a nonprofit policy think tank in DC. This series is designed to help advocates, assisters, state and local officials, and others assist people access and understand the Affordable Care Act's health coverage options. It is intended for those working on the implementation of health reform and is not intended for press purposes. Today's webinar, the second in a four-part series on key elements of eligibility and enrollment, will detail the rules used to determine household size and will explain what counts as income when determining eligibility for premium tax credits and Medicaid. Now, to guide us through today's topics, please welcome Tara Straw, Senior Health Policy Analyst, and Shelby Gonzalez, also a Senior Health Policy Analyst. And with that, I'll turn it over to Tara.
Thank you, Hallie. Welcome back, everyone. We're going to talk about some tax topics today, how to determine households and income on the enrollment application. So household size matters because it is one of the variables that will determine what percentage of the federal poverty line someone's income is. And we know that that's really important because that will place them in Medicaid or the premium tax credits or out of the premium tax credits. And it will determine, whether they get cost sharing reductions and at what level. So determining household and income are both really important in the eligibility process. And you saw this in the webinar on Tuesday, but here is what the expected premium contributions look like for 2018. You can see at the lowest income levels, people would pay 2.01% of income, and it goes up pretty sharply to people at 300%, who would pay 9.56% of their income toward premiums. And so you can see, if you're looking at this, how important it is to get that FPL pretty accurate. So if you have a family and you think that when you fill out the application based on their income and family size, you say that they're at 150% of the federal poverty line. But then, maybe they didn't tell you about all of the income, or maybe a person we thought was going to be a dependent drops off the application. Then at the end of the year, they may be at 250% of the federal poverty line. And at that income, they will pay not only a higher percentage of their income, but a higher percentage on a higher amount of income. So the swing between what we anticipated at the beginning of the year and what happens at the end of the year can be great. And that's where people get, sometimes get upset about their taxes. So we want to do as much as we can to be as accurate as we can at the start of the process. Tax filing status is one of the things that we need to consider, because there's this pesky little question in there that says, is the taxpayer married? Well, there's a lot that goes into that question, and that relies on tax definition. So here are all of your options on a tax return. You can be single. If you're single, that means you are not married. And I say this to the tax clients I work with all the time. It doesn't mean that you are married, but you haven't seen your spouse in a while, your spouse is with someone else. It means that you are not married, or that you're legally separated, legally like you went to court, or you're divorced. Also, you went to court. So that's who's single. Or someone might be married filing jointly. People don't have to live together to file their taxes together. They just need to be legally married in their state. Next is married filing separately. That's a person who is married, whether they're living apart or separately, and they file taxes separately from their spouse. Next is head of household. We're going to talk in more detail about head of household, but this is a person who is either unmarried, so someone who is actually single, or is considered unmarried for tax purposes, and also pays more than half the cost of keeping up the home for a qualifying person, whom he or she will claim as a dependent. We're going to unpack that in the next couple of slides. Or someone could be a qualifying widower, but to claim that status, they need a dependent child. So all of this is important because there's a rule in the premium tax credit section of the law that says that a person who is married must file jointly with his or her spouse in order to be eligible for the premium tax credit. So we need to look for people who are going to be married filing separately and either find a different tax status that's valid for them, or have the sad duty of telling them that when they answer these questions, they're not going to be eligible for premium tax credits. There are some exceptions to the joint filing requirement, and Judy talked about these on Tuesday. They are someone who is head of household, someone who is married but is a survivor of domestic abuse, or someone who is married but has been abandoned by their spouse. These are carve-outs that the IRS has made to make sure that people can receive premium tax credits even when they would otherwise be ineligible. And do remember that a person, if a person is filing taxes and is married filing separately and they don't qualify for one of these exceptions, they're still Medicaid. So remember that these rules about tax filing status don't apply to Medicaid. And they could also purchase health insurance full cost in the marketplace. It's just a restriction on claiming the premium tax credit. Okay, so let's dive into head of household. So we would care about whether someone is head of household only if someone is married but they're not filing taxes with their spouse. Other people might be head of household if they're single with kids, but we don't need to do the work there. We only need to do the work if someone is married and they're not filing taxes with their spouse, because we want to find a way to get them eligible for premium tax credits if we think under the rules they could be eligible. So here are the rules. When can a married person file as head of household? You have to answer yes to all of these questions. Will you file taxes separately from your spouse? Will you live apart from your spouse for the last 6 months of the year? And this, we're talking about the last 6 months of 2018, so we're looking ahead. Will you pay more than half the cost of keeping up your home? You really have to be the breadwinner in the home. Will your child, stepchild, or foster child live with you for more than half the year? Half the year here can be any half of the year. It doesn't have to be the last half the way it does in the rule above. And will either you or the child's other parent claim the child as a dependent? So if you could answer yes to all of these questions, then even a married person can be considered head of household. So here's an example. We've got Chuck and Dante. Chuck is separated from his wife, but they're not divorced. They do not plan to file taxes together next year. You hear lots of stories from people, I'm sure, in your work about their relations, all their relatives and all their relationships with their relatives. Dante is Chuck's adult son. Dante is unemployed, he has no income right now, and he's living with his dad. So does Chuck qualify to file as head of household? Your first impression here is that he's married filing separately. But can we get him to qualify as head of household? He'd have to answer yes to all of these questions. Yes, he's filing taxes separately. He does plan to live apart from his spouse. He definitely pays more than half the cost of keeping up the home. His child lives with him. And yes, he's planning on claiming the child as a dependent. And so that means, yes, Chuck is going to qualify to file as head of household because he is, quote, considered unmarried. It's a term of art by the IRS. Therefore, when Chuck is asked if he is married, you can say no. So yes, we know he's married, and yes, we're always answering these questions truthfully, but this is the workaround because the system doesn't ask the questions right. This is our certified, approved by the marketplace workaround for this. So because the IRS would say he is, quote, considered unmarried, you can answer no to this question. But let's change the facts up. Let's say that instead Dante has a job and he's not Chuck's dependent, but he still lives with his dad. So how does that affect Chuck's ability to get premium tax credits? Well, there's a problem because Chuck is not going to be able to claim his son as a dependent. And so that is going to mean that Chuck is not able to file as head of household. And when we get the questions, is Chuck married? Well, we have to say yes now because we don't have head of household as an out. And does Chuck plan to file a joint federal income tax return with his spouse for 2018? Well, the answer is no. They're not together. They don't plan to file together. So, when the marketplace recognizes the answers to those questions, the response is going to be that no premium tax credit is applied. Here are some other exceptions to the joint filing requirement for premium tax credits. First is domestic abuse, and again, Judy talked about these on Tuesday, so we won't go into a lot of detail, but this is for a taxpayer who is married filing separately and lives apart from the spouse and is unable to file a joint return because of the domestic abuse. So again, this is another case where they would get the question, is Fiona married? And the answer would be no. Why? Because she qualifies for this exception. The second exception is for abandoned spouses. So this is someone who lives apart from their spouse and they cannot locate their spouse using due diligence. Due diligence being things like, his last phone number, try calling that, things like that. So you can't actually find the spouse, then the IRS has created another out so you don't have to have your ability to claim premium tax credits resting on that. So again, you would answer no. These exceptions can be used by people for a maximum of 3 consecutive years, and I believe that this will be the 4th year. So there may be people who've used this exception 3 years already, and now will no longer be able to use the exception. So look out for that. I think the IRS's hope in putting a cap on that is that people will change their position. If they're married, they will get divorced eventually. So look for that. We did get a question in following on Tuesday's webinar that asked, does healthcare.gov track this? And the answer is no, because healthcare.gov just knows whether you answered the question, is so-and-so married, yes or no. They don't know, you did it because you were head of household, you did it because you were qualifying for this exception. So it's really up to the applicant to know what they've said in the past, whether they've claimed this for 3 years or not. That's something you can work out together with the applicant. So now we're going to talk more about the rest of the household. When we talk about households, we're talking about a tax unit. We're not just talking about the people you live with. We might be talking about some of the people you live with and some people you don't live with who are part of your tax household. In general, when I say taxpayer, I am talking about the taxpayer and spouse. And then we're looking at tax dependents. These are people that you can claim a personal exemption for on your tax return. A household is going to include all individuals in the tax unit, even if they are ineligible for premium tax credits or have another source of insurance coverage. So when we're looking at someone's position against the federal poverty line, we're going to consider the whole family, even if only one person in the family needs health insurance. So there are 2 kinds of dependents. And that's all you need to know. You just need to know the 2 kinds of dependents to figure out if the children or other people in the house can be considered one kind or the other, or not at all. So the first kind of dependent is a qualifying child. A child can include not just the little kid who comes with mom to complete the application and is like flicking the lights on and off, not just that kid, but also stepchildren, adopted children, foster children, brothers, sisters, nieces, nephews, grandchildren. All of these relations can make you a qualified child. There are other rules too. The person has to be a U.S. citizen or resident for tax purposes of the United States, Canada, or Mexico. The child has to live with the tax filer for more than half the year, and we'll talk in a second about some exceptions for custodial parents. The child has to be under age 19 at the end of the year, or under age 24 if they're a full-time student. The child can be any age if disabled. So you could have, for instance, someone who is caring, an adult who is caring for their uh, uh, adult brother with a disability, who is, 45 years old. Well, that brother would still be considered to be a dependent if all the rest of the tests are met for the purpose of this. Um, and the child can't provide more than half of her own support. So that means we're going to be looking at the income that the child has, which is often none. There are special rules for the children of divorced and separated parents. The way that this factors into the premium tax credit is that the parent that claims the child as a tax dependent can claim the premium tax credit for the child. And that's the only parent that can claim the premium tax credit for the child. This is usually going to be the custodial parent. And when I say custodial here, I'm not talking about necessarily a legal custody arrangement. I'm talking about where the child lives. If the custodial parent claims the child on the tax return, then that person is going to be responsible for ensuring that the child has health insurance or paying penalty for that child otherwise. The custodial parent is the one that can claim the PTC for the child, assuming that the custodial parent is the one claiming the exemption. Sometimes a child is claimed by a non-custodial parent, and this might be written into a divorce decree saying that the non-custodial parent has you can claim the child every year or every other year. And in this case, the custodial parent is going to sign over a tax form, Form 8332, to grant the non-custodial parent the child's exemption. Now, why do you need to know that? You don't need to see the tax form. You don't need to know the tax form's number. What you need to know is that this is a formal arrangement. And so if someone comes in and, they're not sure really what you're asking about household. Their child doesn't live with them full time, but they still consider the kid a part of their household. So you're asking about relations, and the question of this child comes up. And what you're really going to need to know for this, since the child is not living with the person in front of you, is that child's other parent going to sign a tax form that says that you can claim that kid? And usually that stops the discussion pretty quickly. So because they know that okay, we're not going to do that. Or they know, you better believe it because I've got it in a divorce decree, and do you know how much my lawyer costs? So that's where the conversation can go. That this is a formal arrangement, and that's what we're talking about here. And if granted the child's personal exemption, the non-custodial parent, again, is going to be the one who's responsible for either getting that child insured or paying a penalty. And in that case, the non-custodial parent would be able to claim the premium tax credit for the child. It's important to know that this is different from when a divorce decree says that one parent is responsible for the health insurance of a child. So sometimes that will happen. Let's say the child is living with mom most of the time. We'll consider, using our terms here, we'll consider mom the custodial parent. But dad in the divorce decree is required to make sure that child has health insurance. Unless dad is claiming the personal exemption for that child as well, he's not going to be able to enroll that kid in premium tax credit. So there's a real intersect here with family law. The other way that someone could be a dependent is if they are a qualifying relative. Now, a qualifying relative can be, well, it can be virtually anyone. It can be a relative, someone who's related to you in any way except cousins. IRS does not recognize cousins. Or it could be a full-time member of the tax filer's household who is not a relative. So let's walk through the rules for a qualifying relative. The first rule is that you cannot be claimed as a qualifying, is that the dependent cannot be claimed as a qualifying child. So, there are always some degrees of choices in taxes. And so if a child is clearly someone else's qualifying child, you can't throw them on your return. They have to be, again, a U.S. citizen or resident for tax purposes of the United States, Canada, or Mexico. The dependent has to receive more than half of his support from the tax filer. And the dependent has to be, as I said, either related to the tax filer or live in the tax filer's home all year, 365 days, with some limited exceptions. And the dependent has to have gross income of less than $4,050. Now that's the number for 2017. We don't have the number yet for 2018, but let's assume it's around $4,100. And that number doesn't include Social Security, generally. So let's apply the rules. So we've got Jane. She's 27 years old. She's living with her parents rent-free right now. She's starting a new career, and she works as an unpaid intern. She has no earnings. Can Jane be claimed as a qualifying child? Well, if we go through the rules, we see that, well, she meets all but one. Unfortunately, it's her age that's going to get her because she's not under age 19. She's also not a full-time student, even though she's an intern. And she's also not under 24. She's not disabled. We don't have any information to indicate that she has a disability. So the answer here is no, she can't be a qualifying child. But there's another option. Can Jane be claimed as a qualifying relative? So let's test this one out. And we see that, yes, she receives more than half of her support from the tax filer. She's related to the tax filer. She has gross income of less than $4,050 for 2017. And so she meets the test, and she can be claimed on her parents' return as a qualifying relative, which means that when she comes in to do her application to say that she needs health insurance, we may or may not be considering her parents' income. And Shelby is going to walk us through some of the more complicated rules that build off our basic understanding of the definitions of tax dependents and tax households, the rules as they apply to Medicaid.
Thanks, Tara. And hello, everyone. So here we are again. We are ready for a new open enrollment season, and I get the pleasure to talk a little bit about these Magi Medicaid households, which are indeed a little bit complicated. So there are several differences between Medicaid and the premium tax credit households. While the premium tax credit household is the same as a tax filing unit, as Tara just described, Medicaid has a lot of exceptions. The good news is that the eligibility systems are supposed to automatically determine the household sizes based on the answers that consumers provide during the application process, and assisters are not responsible for determining the household sizes themselves. However, the rules are helpful to know because sometimes eligibility systems are not always right. That never happens, right? Or sometimes the application maybe solicits an answer in a way that can confuse the consumer, and then that ends up with this weird kind of eligibility. So knowing the rules as an assister really helps you to kind of spot when there might be an issue, when you know that things don't seem to be turning out correctly in the determination of eligibility. So in Medicaid, Magi rules apply to people who are in the Medicaid categories for children, pregnant women, parents, and caretaker relatives. This is the case whether or not the state has expanded Medicaid. And in states that have expanded Medicaid, the Magi rules also apply to the new adult group. Magi does not apply to people who qualify for Medicaid because they are seniors or people eligible for Medicaid due to a disability. Medicaid looks at each individual's tax status as well as their relationship with other household members in order to arrive at a separate determination of household for each family member. In some cases, households will be the same for all members of the unit, but in many cases it won't be. So there are different kinds of rules that apply based on the individual's tax filing category. So there's these three different categories. People are either tax filers who claim their own exception, There are people who are tax dependents, people who are neither filers nor tax dependents. So for all of these groups, the rules that are applied are based on how people expect to file rather than how they have actually filed in the last year. So we'll use this chart to review each category of the household. And I personally just have a copy of this chart near me, just because I have not memorized all of these. So we're going to walk through this chart because this can get a little complicated on the Medicaid side. So the rules for tax filers, the household of the tax filer who is not claimed as a dependent by another person includes the tax filer and all other people that a tax filer expects to claim as a dependent. Rules for tax dependents, the general rule really is that the tax dependents have the same tax household of the tax filer who's claiming that dependent, but there are 3 exceptions that may apply to this rule. First, a tax dependent who is not a child or spouse of the taxpayer. So for example, it could be like a parent that's living with you, or an adult sibling, or a non-relative who is being claimed by a taxpayer. So second, the next exception is children living with both parents who are not married. In this case, the parents can't file a joint return because they're not married. So in most cases, the parents file taxes separately, and then they decide on which one of the parents gets to claim the children. So then third, you've got kids who were claimed as a tax dependents by their non-custodial parents, and Tara talked a little bit about when that might happen. And typically it's when the custodial parent who claims when it typically really is the custodial parent that claims a tax exemption, but as Tara mentioned, there are going to be times where the custodial parent could allow the non-custodial parent to claim the child for the tax purposes. Okay, if any of these 3 exceptions apply, or if the person is a non-filer, the person's not going to file either taxes for him or herself, and that person's, or the person's going to not be a dependent of anybody else in taxes, then these other rules apply, which is in the right-hand column. For individuals who are 19 or older, the household includes the individual, and if living with the person, the spouse and children up to age 19. For individuals under 19, the household is the individual and siblings under 19, parents and children living with the individual. So those are those. Okay, we're going to go into an example. We have Teresa, Antonio, who are married, and they have 2 children, Gabby and Michael. They're going to file together. They're going to file their tax returns together, and they're going to both claim their children on their taxes. So for each one of them, Teresa, Antonio, Gabby, and Michael, everybody is going to be in a household size of 4. This is really a very, very straightforward example. The dependents too, Gabby and Michael, are also going to be in the household size of 4. So this is kind of what we see often. Now we're going to go and look at a 3-generation household. So Sonia supports her mother, Diane, and her daughter, Kayla. Sonia is a tax filer and claims both her mother and her daughter on her tax returns. So what are the Medicaid households? So for Sonia, she has a household size of 3. Now we're going to look at Kayla. So she is, her household is the same as a tax filer claiming her as a dependent. She does not have any of those exceptions that apply to her. She's a child, she lives with her mom, she's being claimed as a tax dependent. So her household size is the same as the tax filers, and her household size is 3. Now we'll look at Diane. So she is Sonia's tax dependent, but she is not Sonia's child or spouse. Therefore, she is treated as a non-filer. And as a non-filer, Diane's household includes herself and any spouse or children living with her. Sonia is her daughter, but she is not considered a child because of her age. So her household size is 1 for Medicaid purposes. So now we're going to look at another family. We have Dan and Jen, who live together with their 2 children, Drew and Mary. And Dan and Jen both have income. For taxes, Jen claims the children, and Dan files on his own. So they're not married, and they've decided that Jen's going to be the person to claim their children on the tax return. So if we look at Dan first, Dan is counted as a household size of 1, right? He's the tax filer. So who's counted in his household? His spouse or dependents on the tax return, which there are none. So he is a household size of 1. Just he himself is counted in his household. Oh, sorry. Jen is a household size of 3. Jen is the tax filer, and who's counted in her household? Herself and her spouse and dependents. She's not married in this case. She does have 2 tax dependents, Drew and Mary, so her household size is 3. So now let's look at the children. So the children are tax dependents, but they fall under this, one of the exceptions to the tax dependent rule. They're children living with both parents who are unmarried. So using the non-filer rules as it applies to individuals under 19, right, because they're children, for each child we count their parents and the siblings who live with them. So in this case, their household size is 4. So this is one of those cases where you have a household, you have mom and dad and children, they're all living together, but as you can see, there's a lot of differences between their household sizes.
And with that, we're going to take a couple questions, and then we'll do the rest of the questions at the end of the presentation. But that's a lot of information, so I just wanted to go through a couple questions. So first of all, someone had a question about if you have an adult child that you claim as a dependent, you expect to claim them this coming year, so you put them on your application, but then later in the year, they end up getting a job, they can no longer qualify as your dependent, and so you can't claim them at the end of the year. How does that work?
So in that case, and that's a pretty common one, because in examples like the Chuck and Dante example, Dante may not have a job at the time that you're filling out the application, but he might soon get one, and that changes a lot of things about the application. Sometimes it's just family size, sometimes it's family size and income. It's certainly your income against the poverty level, because that includes family size. So it can make a big impact. The best thing to do in most cases is to call the marketplace and to acknowledge the change and see what effect that has on APTC. So that's probably the best advice, is to call the marketplace and make sure that you're updating the marketplace with the change. Otherwise, you could have a situation where you have a big jump in FPL because you have a smaller family size, and then you owe a substantial amount for the year.
Perfect. And then another question about the qualifying relative tax dependent. So there are 2 questions actually. So one, we went over this a little bit, but just to reiterate, can a non-relative be considered a qualifying relative if they meet all of the different criteria? And then a second part to that question, is there any limit to the number of years that a tax filer can claim a qualifying relative?
No, there's no limit to the number of years. And yes, someone who is not related to you can be your qualifying relative. So common example, a couple is living together, but they're not married. They have a couple of kids. They're sort of living as a family unit, but they're not married. And one person is dependent financially on the other. So has, one person's like a stay-at-home mom and dad is out working and supporting the family unit. So in that case, you could have a circumstance where the woman in this example is a qualifying relative of the man, because if you go through the tests, they're not related, I hope, but they live together for the entire year. He is paying more than half of her support. Assume that citizenship or residency works out, and she's not earning more than $4,050. So if you can go through all the tests, then you could have a situation where a non-married partner becomes a qualifying relative for tax purposes.
Thank you. And then do these federal premium tax credit household and tax rules apply to the state-based marketplaces?
The calculation of your household and income will be the same in state and federal marketplaces.
Perfect. And then one last question. We use a lot of tax terms, so someone just had a clarifying question about the difference between a tax dependent and a tax exemption, claiming a tax exemption.
So we're kind of using them interchangeably. So a dependent is like the person, and exemption is, on your tax return, where it's the amount of money that you get for that person, basically, that you get to deduct for that person. So that little exemption is worth $4,000 to you. So we're using the terms interchangeably here. They're referring to the same thing, which is the dependent. Exemption just refers to how you account for it on your tax return.
Perfect. And let's take the rest of the questions at the end of the presentation. So take it away, Tara.
Okay. So now we're going to talk about income. Income is really hard. I will say this because it can be difficult to sort of get out of people what their income is in some cases, unless it's very straightforward. So we're going to do a broad brush look at income. We're looking at the term MAGI, modified adjusted gross income. That is the adjusted gross income, which is the amount at the very bottom of your tax return, on the first page of your tax return. It's line 37, plus non-taxable Social Security benefits, plus tax-exempt interest, plus excluded foreign income, which should be a very rare thing. So all of those together equals MAGI, modified adjusted gross income. Income can be in the form of money, goods, or services. In particular, be on the lookout for cash income, because sometimes people say it and then they try to unsay it. Can't unsay it. Cash income is taxable, and it's going to be included in your MAGI even if people haven't declared it in the past. It's on the side. They just pay me cash. It's not my real job. I only do this during the summer. Any of these reasons. If someone is receiving income for work they do, that is income that should be included on their tax return and on this application. In general, assume that all income is taxable, unless there's a law that says it's not. So examples of taxable income include wages, salaries, bonuses, even that holiday bonus at the end of the year, alimony that you receive, self-employment income, no matter how informal it is, tips, gratuities, farm income, rental income, all of those are types of taxable income that should be included on your marketplace application. Examples of non-taxable income would be things like TANF payments, child support payments, sickness pay, SSI, veterans benefits, workers' comp. None of those are considered taxable income. There's a lot more information from the IRS about what income is taxable and not. You can see publication 17 and 525 for more information if you have specific kinds of income that are not included in this list. Pre-tax deductions are not included in MAGI. So let's say that one person in the family gets health insurance via their job. They have maybe a pre-tax deduction that's related to their health insurance. That is not going to be included in MAGI. So you're really looking at box 1 in the W-2 essentially. Social Security, including survivors benefits and disability insurance, are generally not going to be taxable, but they are included in MAGI of a person with a tax filing requirement. Social Security might be taxable if they also have other income. It can be difficult to figure out when to count a dependent's income. The general rule is that the household MAGI, so the household income, is the MAGI of the tax filer and all tax dependents who are required to file a tax return, which means that you need to figure out is any tax dependent required to file a tax return. That gets a little complicated. So a single tax dependent who is under age 65 and will have a tax filing requirement if they have unearned income of more than $1,000. And by unearned income, we're generally talking about like investment type income. We're not talking about Social Security benefits. If they have earned income that's more than $6,350, or if they have some combination of the two. So if they meet one of those, if they meet the definition and they have a tax filing requirement, then again, look back up at the top line. The household income is the MAGI of the tax filer and all tax dependents who are required to file. So if the tax dependent is required to file a tax return, we need to include their income on the application at the front part of the year. If a dependent has a tax filing requirement, both a taxable and non-taxable Social Security are counted toward a household's MAGI. So that's why even though the tax rules, sometimes it'll be taxable, sometimes it won't. If the dependent has a tax filing requirement, you don't need to worry about, whether it's ultimately, so the Social Security is ultimately going to be taxable because it's all going to be included toward the MAGI. So let's look at an example of this. This is Jill and Ryan. Ryan lives with Jill. Ryan is her 17-year-old grandson, and Jill claims him as a tax dependent. Jill's income is $18,000. Ryan has income from Social Security survivors benefits of $7,000. And so the question is, whose income is counted in the household's MAGI? Well, here, remember that our definition of household income is the MAGI of the tax filer and dependents who are required to file a tax return. So is Ryan required to file a tax return? The answer here is no, because we don't include Social Security benefits in the unearned income amount that might require you to file a tax return. So here, Ryan does not have a tax filing requirement. His income is not counted. We're just looking at Jill's income. And this is true even if the check comes care of Jill. So even if Jill's name is on the check because Ryan is a minor, it would still be considered Ryan's income, and it wouldn't change the scenario. But let's make a change. Let's say that Ryan's income is not from Social Security. In fact, it's from a part-time job. Well, in that case, remember a few slides ago our definition of when a dependent has a filing requirement. We said that they have a filing requirement if they have earned income of more than $6,350, and here Ryan does. And so Ryan does have a tax filing requirement as a dependent, and so his income is going to be counted toward the household's MAGI. Let's change this again and say he has both kinds of income. He has both a part-time job and he has Social Security survivors benefits, each in the amount of $7,000. In this case, we do that threshold test. Is Ryan required to file a tax return as a dependent? And the answer is going to be yes, because of that part-time job. That part-time job triggers a filing requirement. And once the filing requirement is triggered, we need to bring in that Social Security survivor's benefit too. And so Ryan is going to have an income of $14,000, which means the family's income here is going to be $32,000. And now turning it back over to Shelby.
Thanks, Tara. Okay, so we've reviewed premium tax credits and Medicaid households and income rules. So now we're going to put it all together and see how they work with each other to determine eligibility for families. We'll walk through a couple of quick examples. So first we have Sonia, Kyla, and Diane again. And Sonia lives with and supports her mother, Diane, and her daughter, Kyla. Sonia makes $35,000 a year, and Diane has occasional work that she makes about $3,000 a year. So Sonia is the tax filer. She claims Diane and Kyla as tax dependents. So let's look at how eligibility works for each family member. So the marketplace will first try to determine eligibility for Medicaid, right, using Medicaid rules. So we determined that Sonia and Kyla have household incomes of $35,000 and their household size is 3. This puts them at about 71% of the federal poverty line, which in most cases, Kyla, that would make her eligible to qualify for either Medicaid or CHIP in her state, depending on the state's levels. And Sonia will qualify for premium tax credits and cost sharing reductions, even though So even though Diana is Sonia and Kyle is in their household, her income does not count towards their eligibility. It only will count the income of the Magi tax dependents if the tax dependent has a tax filing household, as Tara just talked about earlier. So Diane is in a household size of 1. I just want to see if I'm missing any of the, okay. So Diane is in a household size of 1, and her income is $3,000, which puts her at 25% of the federal poverty line for Medicaid. So she would qualify for Medicaid if the state expanded Medicaid eligibility for adults in her state. If not, let's see if she would qualify for premium tax credits. For premium tax credit eligibility, Diane's household size is equal to the household size of the person claiming her as a tax dependent. So that means her household size is actually 3 when we're looking at premium tax credits. So Sonia's income counts towards her eligibility. So she is also at 171% of the federal poverty line, just like Sonia and Kyla would be, and she would qualify for premium tax credits and cost sharing reductions under Marketplace. So now we're going to go and look at Diane and Jen again. So Diane and Jen live together with their children, Drew and Mary, but they're not married. For Medicaid, Dan is So for Medicaid, Dan has a household size of 1, and his income is $18,000 per year, which puts him at 149% of the federal poverty line. He's not eligible for Medicaid. For premium tax credits, his household size and income are the same. He is eligible for premium tax credits and cost sharing reductions. Jen's household size is 3. It includes herself and her 2 children that she claims as tax dependents. Her household size for Medicaid is 3, and her income is $26,000, which puts her at 127% of the federal poverty line. If her state expanded Medicaid, she would qualify for Medicaid. If not, she would qualify for premium tax credits and cost sharing reductions. So let's think about Drew and Mary now. So Drew and Mary have a household size for Medicaid of 4, and their income, in the income of both parents would count when we're looking at Medicaid, right? So their income is $44,000 per year. They would be at 179% of the federal poverty line. They would most likely qualify for Medicaid or CHIP in their state. Most states are up to that level. If they did not, The marketplace would say their household size is the same as Jen's because she claims them as tax dependents, and it would say that the children's income was that of their mother, which is $26,000 a year. This would mean that they would have an income that is at 127% of the federal poverty line. So now I'm going to turn it back over to Hallie to see if we have any questions.
And we do. We have lots of really good questions. So first, we're going to have kind of a complicated question. So let's say you have a person who is right around the eligibility between Medicaid and premium tax credits. And they go through the application and are the end of the application, it says that they may be eligible for Medicaid. Their sort of enrollment file is sent to Medicaid, and then it comes back and they've been denied eligible for Medicaid, and they're actually eligible for marketplace coverage. So could you kind of explain why that might happen and what people should kind of do if that does happen?
Sure. Should I take that one? Okay. So so that could happen for a lot of different reasons, especially for people who have seasonal employment, and maybe you know, the way that the marketplace is going to look at your income, they're going to ask you, they're basically analyzing your income, your projected income for that coverage year. In Medicaid, the first thing that Medicaid is going to be doing, it's going to be looking at your current monthly income. So, and it may never get to the point where it's asking you, because the state has some options as to how to treat this kind of seasonal employment. So what might end up happening is, you started off in the marketplace, they send you over to Medicaid, then they send you back over to the marketplace. At that point, the marketplace will ask the person, have you been denied Medicaid, eligibility for Medicaid? It's a question that's in the federally, well, in healthcare.gov at least. This is how they deal with it. And when you indicate that you have been denied eligibility for Medicaid, that should help trigger so that the marketplace knows that this is somebody who is not does not meet the Medicaid requirements, and will determine your eligibility based off of premium tax credit rules.
Perfect. And now, so we talked a lot about tax filing requirements, and if you have someone who is just an individual and they're applying for coverage, but they've never filed a tax return in the past, they don't have a tax filing requirement. Does their income, how do you count their income? Does all of their income count? Do they have to file a tax return in the next year if they apply for coverage?
Well, it really depends on the income of the person. So if we know for sure that the person doesn't have a tax filing requirement, which means that their income for their tax filing status is below a certain amount. So I think for single, oh, I don't even want to guess what the numbers are. It's in the IRS publications. But if we know that they have no tax filing requirement, then and they enroll in Medicaid, which they probably would at those income levels, then they don't need to file now just because they enrolled in Medicaid. But if they have not previously filed taxes but are eligible for premium tax credits, now they do have a tax filing requirement. Irrespective of income, accepting an APTC does require you to file a tax return at the end of the year.
Perfect. And then let's see. Oh, this is a good question. So, way back in the very beginning, when we talk about, when we talk about the federal poverty line and where you are on the federal poverty line, and we are using the 2017 guidelines for 2018, can you explain why that is?
It's because we don't have the 2018 guidelines, and nor will the marketplace have the 2018 guidelines by the time they have to begin open enrollment. So the system is set up so for the marketplace, for the entire year, we'll use the previous year's poverty guidelines, because we're sort of keeping a level playing field from the time the open enrollment starts to the end of the year. Now, it's not really the same in Medicaid.
That's right. I'm just nodding yes.
So,
Oh, you wanted me to say it? Yes. So it's not the same as in Medicaid. In Medicaid, as soon as the new guidelines are published, that's when they become effective.
Perfect. And then we'll do a few more questions. Does a dependent who is filing taxes to just retrieve taxes that are withheld, are they defined as having a tax filing requirement? And if they do file taxes, do you need to include that income in household magi?
sorry,
Can you repeat that
yeah,
again?
can you
Yeah.
say that again?
Yes, sorry. So if a dependent is only filing taxes to get withholdings back, so
Yeah.
does that person have a tax filing requirement if they're filing a
No,
tax return to get
no.
withholding? Perfect. And then if they
Well,
do,
yeah,
go
let me
ahead.
let me say more. Let me say
Yes.
more than that. So there are there are some people who will just optionally file a tax return because they were working and their employer withheld taxes. And that might be the case for someone, maybe a teenager who has a summer job or something. The employer might withhold taxes, but if they don't have a tax filing requirement, then they're entitled to get all of that back. And so they can just file a return to get their withholding back, and it's easy. So that doesn't, just because you filed a tax return doesn't mean that you have a tax filing requirement. So those are two different things. Now, if that teenager made enough money so that they did have a tax filing requirement, so if we're talking earned income, it's earned income greater than $6,350. If they have more income than earned income than that, then they do have a tax filing requirement. And not only will they need to file a tax return, but their income will need to be included on their family's marketplace application.
Perfect. Thank you. And then we always get this question, and it's kind of it's a difficult answer, but since we always get it, I will ask it again. So what happens when you have parents that have 50-50 custody? They're divorced, they have 50-50 custody over the child, and they switch every other year on claiming the child on their taxes. How does that work?
Well, so you can sort of cut out the 50-50 custody part of it because it's irrelevant. Um, we're really looking at who's claiming the child on the tax return. And in the years that mom claims the child on the tax return, then mom is going to be eligible to get premium tax credits for that child if all other tests are met. And in the years that dad is eligible to claim the exemption for the child, then those are the years where dad could get the premium tax credit, or will be responsible for paying a penalty if the child is not insured. So it gets very complicated. We would
Yeah.
hope that the people would have sort of very stable health insurance, and they might. I think it's a pretty odd case where you would have the child with both parents, 50-50 custody, parents switching by the exemption by the year, and neither parent having an offer of employer-sponsored coverage. So I think that we get into kind of a theoretical question. In most cases, one parent would have an offer of employer-sponsored coverage, and maybe the child would just be on that the whole time.
Perfect. Thank you. And then we'll do one final question. So if you have a tax dependent who is an adult and applying for coverage just for that adult, but they are a tax dependent, do you count the income of the whole tax filing unit for that person if they're the only ones applying?
Yes, unless when you're looking through the more complicated Medicaid circumstance, then you would look through that Medicaid chart and see if there's a reason that we would not be counting the rest of the family's income. But in general, we're starting with the idea that if a person is a tax dependent, then you've got to include the rest of the tax unit.
Perfect, thank you. And you guys have a ton of great questions, and I know we couldn't answer all of them, so please feel free to email questions to that Beyond the Basics email box that you see on your screen right now. We'll try and answer as many questions as we can, and again, we have a record of all of these questions. But if your question didn't get answered or you think of a new question, please email us and we will get back to you as soon as we can. So a couple of words in closing. We're going to be distributing the slide deck and a video recording of today's webinar. We'll do that in the next week or so. We're going to post everything to our Beyond the Basics website at healthreformbeyondthebasics.org. We have two more parts to this four-part eligibility series. Part one was on Tuesday, and we'll have that video of that webinar if you missed it up soon. Part three is scheduled for next Tuesday, September 26th at 2 p.m. Eastern, 11 a.m. Pacific. It's going to provide an overview of health plan design, including cost-sharing charges, eligibility for cost-sharing reductions, and how all the various cost-sharing affects costs. You can register for that webinar and our other upcoming webinars on the Beyond the Basics website under upcoming webinars. All of our materials from this Beyond the Basics project are posted to that site. We have updated key facts on things like households and what counts as income. We will have an update to our Health Assisters Guide to Tax Rules, which is on the website now, and we'll have updated 2018, 2017 numbers in October as soon as we get all of the numbers for that. If you have any questions or need assistance going forward, please email us. And with that, we're going to bring this to a close. So thank you so much for joining us today, and we'll see you again soon. Thank you.